Good morning and welcome to the COMPTOIR Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Nick Ayerst, CEO. Good morning, sir.
Good morning and thank you. Welcome to the COMPTOIR Group annual results for 2022. Delighted to have the opportunity to update you on our performance and also on our future strategy. My name is Nick Ayerst, I'm the CEO and I joined COMPTOIR Group in October of 2022.
I'm Michael Toon, I'm the FD. I joined just over 2.5 years ago.
Okay, so agenda, we'll take you through an overview and highlights, which I will do. Michael will talk about financial performance. I'll then pick up again on the strategy and operational priorities for 23 and beyond. Short summary, and then in the pack that you'll be able to see on our website, we've got some appendices with some additional information we're not going through today. Okay, so overview and highlights for 2022. It was a year of change for the board, but I'm delighted to say that the new team, chair, non-exec and CEO have settled into a strong working team and making progress in terms of tackling priorities for 23 and beyond. Our franchise partner, HMS Hopes, opened 2 new restaurants. One in London Stansted Airport and one in Hamid International Airport in Doha. Both are performing well in their early months. Stansted opened in June, so caught last summer, and is gearing up for this summer and is already in growth year on year. And Doha opened in September, which of course was in good time to give us some good publicity for the World Cup that was held in Qatar last year. There was a closure of one of our restaurants, and that was in Westfield in Stratford, and that was in January 22, so very little numbers for that site were included in the full year, and that was a natural end to the lease of that location. We've strengthened the senior leadership team during the year, including for the first time in COMPTOIR Group, a specialist full-time procurement manager who's helped us with a number of projects to improve our procurement and logistics. Guest satisfaction ended the year at a net promoter score ahead of the years previously, and that was at 60%. This followed a number of months on focusing on a back to basics program. And that was really part of COMPTOIR Group emerging from the COVID pandemic style of management that we took, obviously, to protect cash and manage the business during that period. So we made sure that we brought our business back fully to get it ready for our guests for 22. We mitigated food inflation costs whilst preserving our strong reputation for value of our food. That was things like looking at our suppliers and our supply chain, looking at our pricing and taking pricing opportunities where it was possible to do so, and also some menu engineering. Financial highlights for the year include we grew our revenue by nearly 50% to £31 million, and gross profit was up 44% to £24.4 million. And that gave us an adjusted EBITDA of £2.8 million versus £3 million the year previously. Michael will talk about key drivers of the differences of those numbers. But we ended the year with a net cash position of £7.8 million, which is ahead of 2021. I'll now pass you on to Michael, who will talk you through the financials in more details.
Good morning, everyone. Over the next 3 slides, I'll just take you relatively quickly through some of the headlines. So we'll look at the P&L. You'll see there was an EBITDA reconciliation, income statement as well. And then finally, the balance sheet, just to really ensure clarity. Well, I think a lot of it is relatively self-explanatory in the year. Like many who've reported on 2022, we saw similar themes to other restaurant groups. We saw our revenue increase, and we continue to see that increase now, but input costs have also risen, which did see a dampening of some of the profit margins. For those who did attend any presentation last year, I noted what we really wanted to achieve was a similar result to 2021 in terms of our EBITDA performance. That was to be based on hopefully a normal trade year, offsetting what had been a very heavily supported year before from government support in general. And in reality, that's exactly what happened. So overall, we were very satisfied as a management group. So as Nick said, revenue increased to 31 million, which was nearly 50% up on the prior year. I'd also note that there were still quite a few moving parts in that year, with VAT at 12.5% across Q1, returning to 20% in Q2 onwards. That compares to the previous year, where it was 5% and 12.5% at various points. So over the course of 2022, VAT actually impacted us by around 2.7 million if you're comparing. We also had to deal with quite a lot of industrial action, and unfortunately, as we found only last week, that is still ongoing, and that impacted numerous trading days. Very hard to avoid, unfortunately. So on that basis, we were really pleased with the revenue. We also have franchise sites in here. We have 6. They perform very well. It probably should be noted that restrictions were lifted actually slower across Europe, so we're actually still seeing them growing faster now. But if we converted the franchise income we received to system sales, that would be the equivalent of around 7.4 million. So we'd be edging towards 40 million as a group on that basis, which is a great position to be in if you even look at our historicals. Moving on to costs, as I noted, we're certainly not immune to cost increases, and they were really unavoidable for businesses last year. And that's reflected in the EBITDA pre-IFRS falling to 9.1% as a conversion, although very much in line with what we expected. So you can see on here, gross profit, 24.4 million. That fell as a percentage of revenue to 78.7%. That was a decline on the prior year, and that's really on the back of the aforementioned VAT increase, which is an impact of around 1.7 percentage points, but also inflation, which really did take hold as the war in Ukraine impacted really F&B across the world, if we're honest. Not just in cost, but distribution, quality, and even quantity. And this inflation is the main contributor to the rest of the fall in the gross margin of 1.4 percentage points. So we ended up with a blended inflation of around 8% last year, although various products, as I'm sure everybody will remember, various points were dramatically higher, oil and protein particularly. So the move of the procurement team in-house, reporting to myself, and our recent supplier project, which has consolidated quite a large number of suppliers down to something far more manageable, have helped us to really offset costs, I believe, as well as anyone, if I'm honest. The distribution costs are really our labour costs. These rose by 22.7%, which is to be expected as trading accelerated by nearly double that, or over double. These were well controlled by the operations team and the site team, and that's despite NMW increasing 6.6% last April, and the well publicised pressure that everyone is under to get and secure good labour. So we've never lost a trading day to labour problems. We've always had a really strong team, and that's helped us to achieve these results that you see here. Moving on to admin costs, just so everybody knows what we're looking at here, they're made up of really 3 meaningful amounts. There's depreciation, 3.3 million, of which the vast majority is rent, because this is on IFRS 16, which includes the rent in depreciation rather than above the line. We have exceptional costs of 1 million, which purely relate to the reconstitution of the board, which Nick has already noted. That is definite one-off, and obviously had a huge impact on the numbers. And then we have 7 million for all the other costs in the business, which is really your maintenance and cleaning, etc. Just to explain a couple of the other numbers on here, other income of 292 can be split into 121k for reopening grants from local authorities and 171k, which is the final settlement of all the rent concessions, which obviously has been a huge job over the last 3 years. But in context, in the prior year, these were 0.9 million and 1.3 million, so obviously a significant difference to the year before. The finance costs, they consist of 94k interest on our C-bill, and the remaining amount being the IFRS treatment of rent, which we've just talked about. So overall, I think we're hugely satisfied with the profit figure of 588k. It's a great profit number. If you look over the last 5-6 years of the company, the last 2 years have been incredibly strong, which I think is a testament to the team here. And we look forward to continuing that as we go forward. Just moving on to profitability, and we've given you a little breakdown of EBITDA and some of the adjustments that are made. So as a company, we do use the pre-IFRS 16 EBITDA metric, which I believe is the closest measure to underlying performance in this regard. The main difference, again, being that this contains rent as an admin charge rather than depreciation and interest. So on this basis, EBITDA was 2.8 million off the 31 million pounds revenue, and compared to the previous year of 3 million, which, as I've already noted, had significant government support of nearly 4 million pounds. So fantastic to get back to very near to the same figure of EBITDA, which is what we wanted, considering we were impacted by the war in the Ukraine, amongst other things which weren't expected. So really strong year, especially after the turmoil of the last few years, and the return to the VAT of 20% as well. We've then had to endure the cost of living crisis and inflation in general, which affects us, as well as our customers. And the hottest topic of the year, which I just wanted to talk about very quickly, was energy. Obviously, generational increases in the energy numbers. We've never seen anything like it, and I don't think we ever will again. So while a small select of companies may have been fully hedged for the entire period, the vast majority weren't, and found credit and fixing prices actually almost impossible for 4 or 5 months during the year. We were in a relatively strong position. We were on a 2-year agreement that ended in September 22, so we were fully hedged for 3/4 of the year, which protected us extremely well from the worst of the situation. We then took on a 1-year bridging contract, which runs until September this year, which helps protect us from any out-contract rates or further market increases. We are benefited, of course, from the first 6 months of the government cap. We've also done an awful lot on the operations side, using systems such as wattage and kaput to make sure everybody is as efficient as they can be in the use of that energy. And then most importantly, relatively recently, in the last couple of months, we contracted for our broker to a 100% renewable flexible product. That's contracted until September 25, which is it's effectively a floor and cap product. So while we can forecast with some certainty within these parameters and protect ourselves from significant rises, we can still take advantage of a significantly lower, although just to be clear, not near 2020 levels yet, but a significantly lower fall in market, which is what we've done so far. And we've actually hedged 20% of this year already, price of 13.7p, so significantly different to what we were seeing last year, which is great news. So going into 2024, there's a real hope that we'll expect to see these increased costs really falling back. Utilities inflation have started, they've already plateaued, and that gives us a much more solid base to work with going into the following couple of years. And then finally, just moving on to the balance sheet. The last few years, absolutely exceptional last few years. So the only reference really I want to make is its general strength and the options and opportunity that it gives us. We closed 2022, as you can see on here, with cash and cash equivalents of 9.9 million. And if you consider the exceptional costs in the year, in my eyes, that's a really strong number. So we increased our net cash despite those one-off costs. We have the full exec team now in place. We have a management team that's really much remained unchanged under Nick. So we're in a really, really strong position. So excluding debt, net cash of 7.7, great position to be in. The only debt on here is our C-bill loan. So it has no covenants to speak of. At this point in time, had 2.2 million outstanding, and I do know other PLCs have decided to repay that debt early, but as a board, we're in agreement that this cash would be much better invested in new sites and other investments as we see fit. We do invest all of our spare cash in various interest-bearing accounts. So we have a 6-month treasury, we have a 95-day interest account as well, and we fully sweep everything each night. So we're making the most of that money that's in the bank, while we also get ready to open some new sites in the next year or so. Other elements, only for clarity, I'd say trade and other receivables and other payables, they've increased as you'd expect on the back of increased trade, driven by key prepayment accounts such as insurance and rent, and trade and other receivables. And then in payables, really, the return to normal F&B creditor terms, standard terms back in practice, as you'd expect, larger payments on utilities, page work, etc. So just to finish off and really reiterate what we've been saying for the last couple of slides, we've got an extremely strong base from which we can leverage our growth going forward. The aim of opening some new sites, generating more free cash flow. And on that note, it leads back into Nick for a little bit more of the forward-looking initiatives.
Brilliant. Thank you, Michael. I wanted to take the opportunity to talk about the strategic and operational priorities for 2023, many of which obviously now are well underway. First one, and most importantly, is to return COMPTOIR Group to growth. We'll do this pursuing 3 different and clear avenues. Firstly, organic growth within our existing restaurants, and that comes through selective refurbishments, revitalising the teams, maximising the use of our external terraces. A good number of our restaurants have got external areas, and we're maximising those. Looking at our menus to ensure that we're giving people the opportunity to buy at a value price where that is appropriate, but also with the appropriate menu laddering. So if you're in our restaurants on a Friday and Saturday night, you also have the opportunity to trade up. So we've added, for instance, a steak skewer to our menu in April, which is selling well. We'll be investing further in technology, a little bit more about that later on. We've introduced a breakfast menu in the last couple of weeks, so we're extending those day-part trading and also making sure that we maximise on delivery. Whilst delivery in terms of cash sales perhaps isn't growing at the rate it was, and is falling as a percentage of total sales, obviously as dine-in has recovered post-pandemic, it's still a meaningful part of our sales, and we need to protect that marketplace. Secondly, growth through new opening sites. So we're looking to open 2 to 3 COMPTOIR lemonade restaurants in 2023. We're working with agents to secure those sites, and we're optimistic that the first of those is just about to go into legals and be secured in the next few weeks. We're also in the final stages of being clear about the rollout, design, look and feel for our Shower QSR brand. And the hope is that by the end of the year, we'll be in a position to trial 1 or 2 sites under that QSR format as well. And then thirdly, through franchising. So we already have a new site in Abu Dhabi that is scheduled to open in November. That's again with our franchise partner HMS Host. They are due to start on site over the course of the summer and to open in November. We've signed heads of terms with a new franchise partner for a major international airport within Europe. We should be able to announce details of that over the next coming weeks in due course. And we're also talking to other partners that may open up access to other franchise marketplaces, whether that be travel hubs or things like theme parks and other sort of leisure destinations. Secondly, in terms of our operations, we've taken the opportunity to realign our focus on three complementary sectors. And that is casual dining with COMPTOIR Libanais as a brand. That's clearly our largest number of restaurants. Our fast casual offer, which is Shower, which currently has got 2 sites in shopping centres, and then premium casual dining, where we've got 3 sites under the Kenza and Yada Yada brand names. That focus helps us aid with prioritisation, but to be very clear about where we're going to deliver our growth from. But it also gives us a degree of resilience in the marketplace by operating across the 3 main sectors in hospitality. We continue to work on the building blocks of the future through our Back to Basics work and programme, including refurbishing, focusing on the team, making sure that the environments that people come into when they visit a COMPTOIR Libanais or any of our brands is up to scratch and is part of the experience that people come and visit us for. But the service that they get is great, and we continue to grow our NPS recommendations and also our reputation for food. We'll talk a little bit more about our central production facilities towards the end. That's a key part of how we maintain our quality. NPS has grown in Q1 of 2023 over 2022, so that the sort of results of that focus is showing through. Moving on to people, post-pandemic Brexit, it's been difficult to recruit and retain strong team members and management, but we're now close to an ideal team numbers across all of our restaurants. And that's competitive pay rates, improved employee benefits packages are all in place, together with additional support for training for our teams. We're working with our new supplier partners to leverage the benefits from moving to 2 large consolidated suppliers with Brakes and Matthew Clark. These went live in Q1. And we're now working to finalise the last few products into those supply chains. And then finally, a new labour forecasting tool will be in place by the second half of this year. Controllable costs, particularly energy, are a high focus, as Michael said, for both the ops and the purchasing team to make sure that we're not wasting any costs through those 2 lines. In terms of technology, COMPTOIR Group has made big strides in tech over the last few years. However, there are still some opportunities to improve our guest experience and operational efficiency. These include further development of the Order and Pay app, and that's due to go live shortly. So that's QR codes that you can scan at the table, or an app that you can have on your phone where you can place orders, or you can pay your bill if you wish to leave swiftly and promptly at the end of your meal. We're collating more data about our guests through various different sources. As we interact with more guests on a digital basis, we're harvesting more information. And we're using that to then target future communications to each customer grouping, the various different tribes of guests that we have coming through our businesses, and making sure that we're able to tailor offers and information to each of those groups. We will have handheld tills deployed for the summer, particularly helpful in those terrace sites that we talked about. Terraces are about an additional 20% of covers, so on warm and sunny days and sunny dry days from May through to October. They add significant operational capability to us, so those handheld terminals will really help. The final steps of that rollout is happening over the next couple of weeks, and then will be set in every terrace location. Kitchen display screens to help us manage our kitchens, increasing accuracy and speed, will be trialled in the second half of the year. And as mentioned, labour productivity software will be in place very shortly. The board and myself are keen for COMPTOIR Group to accelerate our work on ESG activity. Not only is this the right thing to do for environmental reasons, it's also the right thing to do in our guests, and most importantly, I think, in our team members' minds as well. In a very competitive working environment where our next generation of workers are going to come from people born this century, clearly environmental concerns are a much higher part of the mix in terms of people considering where they're going to be working. We want to make sure that we become an employer of first choice for the widest range of potential employees. Activity that's underway includes, I won't run through all of these in detail, you can see them on the screen, but the key ones: we've joined the Sustainable Restaurant Association. We're working in partnership with them on a 2-year action plan to get us the highest rating that we can through those guys. We've formed a board-level ESG committee, which meets regularly now and is tackling issues and particularly looking at a plan to achieve net zero carbon footprint for our COMPTOIR Group as an organisation. And there's some things that are already underway. So our electricity is already 100% from renewable sources where we're in control of the supply. And as Michael talked about, we're working with technology like COMPTOIR, which manages individual pieces of equipment in our restaurants, to understand how much energy those pieces drive and pull from the system, and what behaviours we can adapt and change to minimise those costs. And then just one other thing to pull out: the consolidation of deliveries to our 2 new suppliers has reduced us from somewhere around 25 individual suppliers, making many delivery drops into our restaurants to 2 key ones. So the number of miles that we've taken out of our delivery routes is into the thousands per week across our 20 locations. So we're very proud of that fact. And then finally, I just wanted to give a little bit more information about our central kitchen. It's an important part of COMPTOIR Group. It's a substantial part of the food. It's about 40% of the food that we buy. We internally buy through our CPU, but it's 14,750 square foot of production space. That is large enough to support long-term growth for the business. It's our largest single supplier to our own business, and it's got the highest available rating from the BRC, and that was audited very recently. So the team did a fantastic job of running high quality production facilities that are very safe. There's a process of continual improvement and investing in process and quality of our ingredients, and the associated R&D that goes along with that brings us some tax benefits that we've been able to reclaim over the last couple of years. But the benefits overall of having a CPU are a consistency of quality, continuity of supply, product development timelines are much shortened from working through third-party manufacturers. It's a cost-neutral operation for us, but growth of the business will reduce those costs. It safeguards our recipes and our IP associated with those recipes and the food that we serve. We're able to supply and sell into our franchise partners within the UK. And it's potentially a long-term opportunity to supply products into third-party white label manufacturing. So finally, looking forward, despite the obvious trading and cost pressures, COMPTOIR Group is in a good position. We're focused on the three complementary sectors, as we talked about, with clearly defined brands, and we're very clear about the strategies for each of those. We've got strong NPS underpinned by well-loved interiors, food and service propositions that our guests understand they love. We have cash reserves facilitating our new restaurant openings, and we've got plans to open sites this year. There's a strong board and senior leadership team in position. But we marry that with founder-led innovation coupled with rigorous implementation of those plans and a proven franchise model as well. So in summary, I'm very confident about 23 and the years beyond for COMPTOIR Group. So thank you very much for your time.
Nick, Michael, thank you very much for your presentation. What I'll do is I'll just bring your cameras up to full screen now. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we received a number of questions throughout today's presentation. And Nick, Michael, if I could just ask you to read out those questions and give response to where it's appropriate to do so, I'll pick up from you both at the end.
Yeah. Okay. You want to do the first two?
Yeah, I'll take the first. It's the first question. What interest is the company earning on the material cash balance it has? Without giving an exact answer, it would be around six figures. So we have several accounts. I think I touched on it during my presentation. So we have a couple of 6-month treasury bonds. We have a 95-day liquidity account, and we also have almost an instant account which swoops every 9 ounces works off the working capital that we need. So we lock away as much as we can and make sure we've got resources going forward. So we use all of that cash. So that's why it still makes sense for us with the debt that we have to maintain that, to put it to better use, which I'm sure we'll get to in a second. Second question, yeah, okay. Is the company planning to use recent falls in energy prices to lock in a better energy deal? Well, yes, we've done that already. I've already talked about that as well. So we're in a flexi contract. It's a fully renewable contract, which is very important to the business as well in terms of renewable energy. We're also leveraging it so we can get the benefits of the forward market, but nobody wants to be caught out. Nobody would have thought what happened last year was going to happen in terms of the utility prices. So we were conscious of that, but we've already hedged 20% this year. We've hedged 20% for the following year at significantly lower prices than obviously what we saw this time last year. So we're in a good position there. We work with our broker on that basis to make sure we purchase when we're comfortable. Probably for you, Nick.
Yeah, I'll pick up the next two. There's a couple of property-related ones. So, what is the planned store rollout in the UK this year? Number of stores and where is the focus? Is that in London or regionally? So, as I covered, we're looking under the COMPTOIR 11A brand to have 2 or 3 openings. We're talking to a number of landlords and agents about sites at the moment. Both in London and externally in the regions. We trade successfully in Exeter, Bath and Manchester and Birmingham, for example. So there are some obvious towns like Cambridge and Brighton and Guildford and those sorts of places that we will be looking at in the regions. The one that is just about to go to legals that we think it's most likely to open first is actually within the Greater London, and there's certainly room to get a number of new COMPTOIR sites within central London. Allied with that then was what do you look for in a new location, and what's your typical store fit-out cost? From scratch and core fit-out costs would be typical of restaurants, which would be between £750,000 and £1 million. Currently, we would need to test that out. It's been a few years since COMPTOIR has opened a new site, and there's obviously been some quite serious inflation within that building sector, as well as labour inflation and food cost inflation. So that's something that we'll be working on when those sites come up. What I can say is that our preference for the time being, and there are a number of these sorts of locations out on the marketplace at the moment, are restaurants that are partially or fully fitted out in reasonable condition, where it's a conversion cost which is substantially cheaper and varies by site. So that would be our primary concern.
Okay, I'll probably take the next one. Could a broker be engaged to provide research and forecasts for retail investors? Well, absolutely yes, they could. And it's something that we become very close to doing over the last year. We'll see a few reasons why that didn't happen. So Q1 last year, we'd actually done almost ready to release, and then we had the war in Ukraine, energy costs, and inflation, cost of living prices, which obviously materially changed a lot what we were looking at. We were coming around again to doing it at the back end of last year, but we obviously have a new board in place and strategy being fully agreed, all in place now. And I think hopefully maybe by the back end of this year, it'll be something we actively look to do and release.
Okay, the next one, can you provide an update on recent trading and current cash position? Well, the cash is broadly in line with numbers at the end of 2022. So there's been no significant use of that cash, and Michael's talked about where that is in place at the moment. And in terms of current trading, it's in line with budget and board expectations, but we won't be getting into any further details on current trading here and now. I'll pick up the next one, which is after all the board issues, how are relationships with Tony Kittus and how is that impacting business performance now? Well, in reality, the business and Tony Kittus relationships were never a real issue. So there were more individual and personal relationships, I think, that were the cause of those. So Tony is the creative director, a board member and large shareholder of the company. And he's fully actively involved, as you would imagine a creative director would be. So he oversees menus, he oversees refurbishments and new store designs, and leads activity. We did an activation in Chelsea last week for the Chelsea Flower Show, so he led a lot of activity there, and he's actually got an event on in the same restaurant at Chelsea this evening where he is cooking. We've got wine tasting. He's leading a sort of cooking session, and we've got guests coming in and interacting, mingling with Tony, and getting a signed copy of his book. So Tony is fully involved in the business and helping support and drive the business forward. And then would you elaborate on the European, final question that we've got on the screen so far, would you elaborate on the European franchise opportunity? I can't say too much more at the moment, so we've signed heads of terms, but we're not quite in a position to go public on that. It is a major European international airport. It's one of the large franchise operators within the travel hub sphere. We already partner with HMS Host, so that will tell you that it's not them. But we don't have exclusivity with HMS Host, so it's an opportunity that this new partner has been able to bring to us that we're looking to proceed with. Hopefully that answers that one.
Yeah, Nick, Michael, thank you very much for that. I think you actually managed to address every question from investors. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Nick, could I just ask you for a few closing comments?
Yes, well, firstly, thank people for attending this, and thanks for the opportunity of talking to you about COMPTOIR Group. I came in October of 2022. I had some familiarity with the brand, having actually worked for another franchise partner who franchised restaurant COMPTOIR restaurants in the UK and airports. So I was familiar with the brand, but very pleased when I came in to see the position that the company was in, both in terms of its operational performance, financial performance, and of course the money that it has in the bank account ready for 2023 and beyond. So there's a strong differentiated brand in the marketplace. Our customers love the environments that we create for them. They love the food that we deliver for them, and they love the service that we offer them. The trick that we need to make sure is that we deliver that consistently all day, every day, in every restaurant, and that's the same challenges that every business in this sector faces at the moment. But we've got a very strong team, an enthusiastic senior leadership team, as well as a stable group of people within our restaurants who are keen to take COMPTOIR Group forward. So I'm delighted that we're in a strong position to see 2023 and beyond going forward. Thank you very much.
Nick, Michael, thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of COMPTOIR Group PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.